Kitco Mining special coverage of BMO's Global Metals, Mining and Critical Minerals is brought to you by First Majestic Silver.
Hello and welcome back to Kitco Mining with me, Paul Harris, here at the 2025 BMO Global Metals, Mining and Critical Minerals Conference in Hollywood in Florida. Gold prices and gold companies are starting to excite and show the benefit of higher gold prices on their balance sheets. Joining me to discuss this is Ammar Al-Joundi, President and CEO of Agnico Eagle Mines. Ammar, welcome back to Kitco.
Thank you, Paul. It's always a pleasure to be here.
Now, we have a lot to talk about today. 2024 was a stellar year for the company. You had the highest production in the company's history, 50% all-in sustaining cost margin. You cemented Agnico as the second most valuable gold company. Your share price hit $100 per share. A lot of things to celebrate in 2024, but what has pleased you most from last year's performance?
Paul, what's really pleased us last year, look, I've been in this business for 25 years. Our owners invest in our company so that they benefit when the gold price goes up. This year the gold price went up a lot, and what really pleased us is that we were able to deliver all of that margin to our owners. We controlled our costs. Our costs came in less than 1% from the midpoint of our guidance. And what that means, Paul, and what really pleased me is when the gold price went up, we were able to deliver all of that leverage to our owners, and the record production, the record cash flow, the record earnings resulted in a record share price. And to me, when you're able to reward your owners with a record share price because they've trusted you to do that when gold price goes up, you know, that makes us feel fantastic. That's our job.
Raises the bar for this year a little bit.
Well, gold's going up, and we think, certainly at these levels, we'll make even more money.
Now, you mentioned perhaps a very, very critical thing, and is perhaps something that has overhung the gold sector in recent years. You mentioned how you managed to control your cost. You were very close to sort of guidance. Looking at the 2024 results of the sector as a whole, all-in sustaining costs are up, 5 or 10% depending on the company. Costs continue to go up. How critical is that? Is that just something that investors have to get used to, that costs will incrementally increase, or is there a real ability for CEOs to put a cap on costs?
It's really super important that we try to control costs. So we're giving cost guidance for 2025 at only 3 to 4% higher than 2024, which again was a great year for cost control. To put it into perspective, we're giving cost guidance at $940 cash cost. Right now, that's a $2,000 margin. Our all-in sustaining cost margin at spot prices is almost $1,700. We have to control costs, and it gets to what we talked about earlier, because we want the benefit of an increase in gold price to go, the vast majority of that should go to our owners. And so controlling costs is such an important part of what we do.
Last year, you returned about $840 million to your shareholders, mainly through your 40-cent per share quarterly dividend. With the great results last year, and it sounds like you're expecting great things again this year, why are you and other companies in the sector not increasing dividend payouts?
Well, remember last year we did pay in excess of $800 million in dividends. We also bought back about $120 million in shares, which is a direct return of capital. We also indirectly returned $1.3 billion of capital through strengthening our balance sheet, through reducing debt and building our cash position. So between direct return and indirect return, Paul, it's been over $2 billion, which was about 43% of our free cash flow. We think that's a good number, and I can tell you at current spot prices, we think that return on capital is going to go up even more.
Okay. One other thing you continue to do, you continue to grow by acquisition. And most recently, you picked up the junior developer O3 Mining to add to let's say, the nucleus you've created around your Canadian Malartic operation in Quebec. Yes. In addition, O3 came with a large land package. Yes. It came with the Marban deposit, which is close to Malartic. How do you see that region developing in the year ahead?
Well, you hit the nail on the head on a few things. It's a great land package, and it's a good asset near Malartic. So we acquired Marban for the land package and for the deposit. it wasn't just to grow, it was to grow value per share. And this is what I mean by that. We have at Malartic, we're going to have a mill that is going to be processing 20,000 tons a day in Canada's largest underground mine. 600,000 ounces a year. That's pretty fantastic. But we'll still have 40,000 tons a day of spare mill capacity where we've already spent the money on the capex, and we have spare tailings capacity. So the fill the mill at Malartic isn't about getting bigger, it's about return on capital to our shareholders. We think that we can potentially grow Malartic from 600,000 ounces a year, which is already Canada's largest underground mine. We think there's potentially a path to get to over 1 million ounces a year. And that would be by putting in a second shaft, by bringing in Marban, because again, it's only about 10 kilometers away, and another asset called Wasamac. We think that if we can do all that, we'll get to 1 million ounces a year. And again, Paul, in the entire world, right now there are only 4 mines generating 1 million ounces a year. One's in Uzbekistan, one's in Russia, one's in Indonesia, and of course in Nevada, the Newmont Barrick JV that they share. Between Detour and Malartic, we think we can get potentially both of those mines to over 1 million ounces a year, owned by one company in the best region in the world to operate multi-decade mines. Those are extraordinarily tremendous mines.
Now, the efficiency aspects of your fill the mill strategy make a lot of sense. Take advantage of the investment, the infrastructure investment you've already made. I think one aspect of that perhaps often gets overlooked is the impact that has on the local communities there and the regulators. I imagine they must be very pleased that they can get the benefits of additional mining without necessarily having to withstand the negative aspects of greater land impacts as more infrastructure gets built. Obviously, you have that infrastructure already. What is some of the feedback you get from the local authorities and the local people about initiatives like this?
Well, you're absolutely right, and not a lot of people pick up on that, but you're right. It's not only, Paul, that by us developing Marban, remember, we already have sort of 2/3 of the infrastructure in place. So it's not only that we don't have to build a mill and the environmental, consequences of that. It's not only that we don't have to put in new tailings facility and the environmental consequences of that, but the actual pit that we're going to build is going to be a smaller, more environmentally friendly pit than what Osisko had envisioned. Our view is that they're very smart guys. They do a great job. Our view is that pit was probably bigger than it should have been. And so we think by downsizing, one, we make more money and we don't touch any of the environmentally sensitive areas around the pit. And we think the community will like that.
Now, in terms of growth, this may not be near-term growth, it may not be growth at all, but the company's also been investing in copper juniors, such as the $40 million you put in to take a 13% stake in Atex Resources in October last year. A number of other gold companies are looking at increasing their presence and exposure to copper. What's Agnico's strategy here? What do you envisage for copper for the company going forward?
So we like copper. That said, we're a gold company. We are 98% gold. We're building a mine with Teck in Mexico that's a copper mine. That'll bring us to about 93% gold. So we are still more gold-centric than any of our peers. Our view is a little bit different with regards to other metals. Some of our peers have picked a specific metal. They've set targets. They said they'll go anywhere in the world to do it. We are regionally oriented. We're a gold company. We're going to focus in the regions where we have a competitive advantage. Now, if we find a great non-gold asset that can make our owners a lot of money, then we would look at that. But we're only going to look at that based on opportunity to make a lot of money for our shareholders in a region that we know well and we have a competitive advantage. So it's going to be opportunity driven, not sort of ideologically, we're going to go to 30% this or 20% that.
The gold price is $2,900, $2,950 per ounce, but I think it'd be fair to say a lot of the exploration companies, the juniors, aren't really feeling the benefit from that. They find it increasingly difficult or continue to find it difficult to finance. Agnico has invested in some juniors. Would you say that the bigger companies have a responsibility, if you like, to help fund juniors, given that perhaps the market dynamics have changed and that they can't finance in other ways?
Well, I mean, for us, it's very simple. Our job is to create value for our shareholders. Part of that is understanding what's going around, and we know every junior company around us. So it's not so much our responsibility directly to support them, it is our responsibility to look for opportunities for our own shareholders, which by definition means we're talking to them, and the ones that we think are good, and if they can't get access to capital, they do sometimes come to us, and we do provide capital, we provide technical advice, and it benefits our owners and it benefits their owners.
Okay, when you look at the gold space is very competitive, the competitive landscape. How do you see that changing or evolving at the current times? What do you like, what do you dislike?
That's the biggest competition in the gold space for us isn't our peers, it's other industries. Now, our view, Paul, is that the size of the generalist investor relative to the gold space is almost infinite. And so our job as an industry is to get the generalist investors interested. So if we do well and our peers do lousy, that's not good enough because the generalists won't come in. So we want Newmont to do well, we want Barrick to do well, we want Kinross, Goldfields to do well. We want to do well because if the gold industry does well and the generalist investors look at it and say, boy, that's a good business, they make a ton of money, we want to go into that business. That's what we want. Because our competition isn't so much our peers, it's other industries.
We are at an investor conference, I would argue the best investor conference for the mining space in the world. Are you seeing new investors? Is the sector attracting new investors?
The sector is attracting. We have had more generalist interest. They're longer term, they're looking at the business, and they like what we're doing.
Now, one thing that certain investors appreciate and look for is dividend yield. You've been paying a consistent dividend. Currently, you're yielding about, let's say, 1.6%. Is that enough to attract investors? Should the gold sector, now that companies are generating much more free cash flow, should you be more aggressive in your returns with your dividend payments with the aim of attracting investors?
So we've paid a dividend. We haven't missed one, I think, in almost 40 years. So we always pay a dividend. What we do, remember, we're in a cyclical business. So we set a dividend. We say we want to pay a dividend. And then we set a dividend understanding that cutting a dividend is a lot worse than raising a dividend. So you always want to set a dividend where you're pretty sure you're not going to have to cut it. So in a cyclical business, by definition, you sort of set the dividend here. And this year, where we've made a lot of excess cash, we have returned it to our shareholders. We've returned it through share buybacks and strengthening the balance sheet. So the most important point is the excess cash that we generate, and belongs to our owners, not to us. We're not going to go and do dumb things with their money. We're going to only invest in the best projects, and the excess cash is going to be returned to our shareholders. And frankly, our shareholders are somewhat indifferent as to whether it's a dividend or if it's a share buyback or a special dividend, or they just want to make sure that we're disciplined with their money, and we have been.
Okay, Ammar, let's end with a couple of forward-looking statements, if I may. What do you think will be the key trends and drivers for the gold sector this year?
Well, I don't have a crystal ball, but I break it down into two parts. There are long-term drivers, which I feel confident on, and short-term, which are harder to predict. On the long-term driver, the same thing that's pushed gold up by a factor of 10 in the last 20. A lot of people don't know that. The S&P's up 450%, gold's up 1,000%. That is largely driven by government deficits, by discomfort with fiat currency, with central bankers getting nervous about, do they actually have access to US dollars? Maybe they should have more gold. I see those factors, Paul, which are long-term factors, just as important and just as strong as they've been. And so I think long-term, those factors are still in place. Short-term, who knows? I don't know where gold's going to be next week, but short-term, it's often a function of volatility and risk. And what you're seeing right now is the world is a volatile, risky place, and even short-term gold is going up.
Okay, well, let's bring that back to Agnico Eagle Mines. What are some of your goals for the year? What are some of the key milestones we can expect to see from you?
Well, we've given our guidance last week. Our guidance is the next 3 years. We give 3-year guidance. The next 3 years are steady production at near record levels. Our cost guidance is, up only 3 to 4%. So fantastic margins, industry-leading margins. We have, I think, the best growth pipeline I've ever seen in 25 years in this business, all leveraging off existing assets in good jurisdictions. So I think that we are, and I don't say this lightly, and for a company that's done very well, I think we're in the best position we've ever been in our 67-year history.
Well, congratulations once again on a great 2024. Ammar Al-Joundi, thank you very much for joining us today.
My pleasure, Paul. Nice to see you again.
Likewise. And we have a lot more to come from the 2025 BMO Global Metals Mining and Critical Minerals Conference here in Hollywood, Florida. So hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining special coverage of BMO's Global Metals, Mining and Critical Minerals is brought to you by First Majestic Silver.